One of JP Morgan's analysts came out with a note today that is warning investors of a pending stock market collapse. Essentially, that's what is said. Now, this is partly why the markets were down over 2% today. On the other hand, you are getting new developments from Vladimir Putin pulling out of a nuclear treaty that is not setting a good precedent. On top of that, you're getting some pretty muted earnings from Home Depot and Walmart. That's what we're going to get into here in this video. On top of that, an update from Tesla's vehicle delivery or vehicle registration numbers, I should say, for insurance in China were very underwhelming today. So let's get into this information. You guys know the deal. If you learned something out of this video, hit that like button and subscribe to the channel. So we're going to start with the earnings from Walmart and Home Depot because we're going to run through this pretty quick, and then we have some other things that are more pressing to talk about, but this is still very important. So I think that alone, that saying, goes to show how big of a day today actually was. Now, Walmart and Home Depot are getting ready for consumer slowdown, and basically Walmart and Home Depot reported pretty good earnings for the holiday fourth quarter of 2022, but both of them did not have good things to say about all of 2023, and they didn't really give us the guidance that we were expecting for, aka signaling that they are getting ready for a consumer that is slowing down their spending habits. So that was the first bit of news today that really was not good for this market here in 2023. A bigger part of what is actually taking place today, I would say, is the fact that Putin is pulling out of the nuclear agreement. Essentially, this is an agreement to limit the amount of nukes that can be ready and deployed on a minute-by-minute basis, and to limit the stockpiles, also to have inspections done by the regulators of the UN. So on a couple different fronts, you've been seeing this situation kind of going downhill, whereas Russia has now loaded nukes into submarines in a posture they have never done for a long time now, since like the Cold War. So for a couple of those kind of war-related concerns, the markets are not very bullish today based off that. It's hard to be bullish based off that when you're talking about nukes. Now, I don't think that was actually the biggest driver of this move today. I think it is the multiple bank notes that are coming out. Now, the markets are really focusing on this JP Morgan note, and they do elaborate on exactly why they're saying what they are saying. So the headline of this is, quote, "Damage is done. Stock market likely set for another plunge as economic warning signs abound. JP Morgan caution." Now, if we go ahead and take a look at exactly what was said in this note that freaked out the markets, it says, quote, "Signals are pointing to trouble ahead." JP Morgan analyst led by Mislav Matakita, I'm not sure if I'm saying that right, wrote in a Monday note, posting a slew of warning signs that indicate the latest stock market rally should continue to fade before the end of March, and that this quarter could possibly mark the stock market's high for the year. For one, the yield curve has remained heavily inverted, an occurrence that has preceded every U.S. recession over the past 50 years. Despite growing optimism that the U.S. could skirt an economic downturn, the curve is the most inverted it's been since 1980s. And JP Morgan cautions, quote, "We have never escaped a recession from this point." Goes on to say, additionally, the U.S. money supply, which measures safe assets households and businesses can use to make payments, has fallen abruptly since March and is negative on a yearly basis for the first time since 2006. All while banks have started enforcing stricter lending standards, leading to a sharp decline in credit demand that's been typical ahead of past recessions. Quote, "The damage is done and the fallout is likely still ahead of us," the analyst wrote, cautioning that the Fed's aggressive interest rate hikes over the past year could take up to 2 years to ripple across the economy. Already, mortgage payments as a share of income have doubled from 13% to 26%, and the saving rate has plummeted to almost zero. But Matika, I'm still not sure if I'm saying that right, notes the Fed is still expecting to hike rates at least 2 more times this year, and stocks have never hit a cyclical low before the Fed has stopped hiking. So it looks like, for obvious reasons that we just went over, the markets are concerned today. All three of these things, earnings from the largest retailers in the world being bad, nuclear posturing that does not look good for obvious reasons. Nobody wants that. Never going to be a good thing for the stock market. And also JP Morgan and a couple other banks coming out with negative things to say about this market after, by and large, they've been pretty positive on 2023 so far, is a change in sentiment from the large banks. And after all, the large banks, they have the most data on the consumer, what money's coming in, if money stops coming in, if people are starting to, not bring in as much money, or if they're starting to lose their jobs, so on and so forth. The banks have that degree of information, right? They have a lot of information. People tend to listen to the banks. Now, what is interesting about this move today is you're actually not seeing the probability of a 50 basis point rate hike going up today, which has really, over the last couple of days, preceded the stock market going down, has been the odds of a 50 basis point rate hike actually going higher. And that is not happening today. The odds are actually going down by almost 6% here today. I think that is very interesting, and I think that does not look good in terms of where this market could potentially go. Now, on top of that, Tesla was down about 5% today. A very rough day for Tesla, and it is because vehicle registrations for insurance in China have fallen 15%. And it says Tesla's insurance registrations in China fell for the second consecutive week as the global EV giant's top competitors in China are ramping up deliveries. Tesla stock dropped Tuesday with recent Tesla crashes and a possible lithium deal also in focus. Tesla had 5,913 insurance registrations for the week of February 13th through the 19th, down 15% from 6,963 registrations in the prior week, as well as 8,643 in the week before that. Slowing China EV registrations could signal demand is waning after an initial pop following big price cuts on January 6th, where you're also seeing BYD, Li Auto, NIO, and XPeng that are growing their vehicle deliveries week over week. And I shouldn't say deliveries, that's like the first thing that keeps coming to mind. The insurance registrations, BYD having the highest percentage of positive 18% week over week. And then you have XPeng down here at 5% week over week increase. So I think for a decent reason, right? Tesla is going down. It does point out in this article that possibly the Shanghai factory is not sending as many vehicles to China. Maybe the demand is over in Europe or in America, and that could be skewing some of these numbers compared to BYD or Li or XPeng. I mean, they're only pretty much selling vehicles in China. Some of them have other markets in Europe. They might be in a country or two, but by and large, all of their sales are in China as of right now. So, that's what we're getting today as far as the markets, as far as Tesla, and where I think this could really go. If you take a look at some of the technicals, guys, we closed under 400 on the S&P. That is not a good sign. The first level of support that it looks like from here is going to be about 390. If you hold 390, that's going to be very good, and I think you likely will. I don't really expect to obviously go down to the lows right now, or to really, head back down to where we were even at in December, around 370, 380, just because you've gotten large tech earnings out the way. You've gotten the FOMC meeting just 2 weeks ago now. You've gotten inflation data, you got PCE, you got PPI, and the markets really didn't react negatively to that. Now a change in sentiment could bring you down from 410 a couple days ago to 390. That sounds reasonable to me. You also have the Fed minutes coming tomorrow, which could be pretty bullish because that took place before essentially this last CPI report came in hot, right? When the narrative was maybe the Fed will pause rates, and the Fed was even indicating that maybe they will pause rates soon. So this FOMC minutes is probably going to be more bullish than not. That comes out tomorrow at 2 p.m. and that could be a big factor that could definitely lead this market over the next couple of days. Beyond that, you're going to get personal spending, personal income coming on Friday, as well as PCE, and that will be the next big day as far as economic data. But from now until then, you don't have a lot in the way. Potentially, I think a more bullish than bearish catalyst coming tomorrow could send, the markets up higher marginally to close out this week, guys. So that is going to be all for this video. Hit that like button, subscribe to the channel, especially if you learned something out of this video, you like my perspective, or you like the stock market in general. We would love to have you here. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.